Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. While I'm doing that, a quick note, anybody join us for the first time, Will and I, we do these shows in the morning to try to help answer any questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you can type it into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we do provide a link to Zoom. When you click on that link, it takes you over to Zoom. Click on raise your hand. We'll let you in. You could ask your question directly. While we're waiting for more people to join us and for question, give you guys a chance to put in your questions, we'll start out taking a look at what's going on in the pre-market hours. We'll use the pre-market report, and then we'll move on to the questions. Okay. So
Perfect.
Pre-market report. These are stocks that are trading in the pre-market hours. We're going to scroll down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. We see there are 77 stocks that made our percentage gainers list, 28 on our decliners list. So from this perspective, right now we're looking like the trading in the pre-market is looks like more bullish sentiment. Let's take a look at it from another angle. We have this calendar view up top, and it's sectioned off by day. It shows us what is going on in pre-market hours from the top, from the high level, from the top level. So right now we're September 14th. We could see that so far there are 492 stocks that are trading in the pre-market hours, trading higher than the previous day's close, 218 stocks trading lower. If we look at the volume, 144 million shares trading on up volume versus 50.3 million shares trading on down volume. And if we convert those shares to dollar value, we have $2.6 billion worth of stocks trading higher versus 453 million stock trading lower. So from that perspective, from the high level, also looks like the trading in a pre-market is indicating bullish sentiment. Let's take a look at it from one more angle, and then we're going to move on to the questions. So we're going to come down to this report one more time. And when we look at the symbols in there, we see that there are stocks in there that are lower cap stocks. We have stocks and we have ETFs in there, leverage products, preferred stocks, could be a closed-end fund. Pretty much any security that's listed on a major U.S. exchange, if it's trading in the pre-market hours and meets the thresholds that we define in there, including liquidity, price movement, volume, it could make this list. And to narrow the list down to a smaller group of stocks, we could use the filters above. So here we could, if you have a watch list, you could filter by your watch list. We're going to use this one filter here in ETF. So when you click on it, you get a drop down menu to select from and you have a list of ETFs in there. The top one, SPY, that's S&P 500 ETF. Let's select that. And when you click on it, the list below, the report below will get filtered by stocks that are holdings in the ETF, which in SPY are the S&P 500 constituents. And here we see 18 stocks made our percentage gainers list, 3 on the decliners. So from this perspective, we are looking like so far the trading in the pre-market is indicating bullish sentiment. So I guess we're already a couple minutes into it. If we have questions, let's just go to the questions at this point.
No questions have come up. Rob is mentioning the PPI number came in a little higher today. Where can people see that on the site again if they want to see any market information that's coming out? Where's that calendar?
Yeah, so if you go to under the news, we're talking about the economic calendar.
Yeah.
Click on here, it'll take you over to the economic calendar. And here we have a list of things that are scheduled to come out today and the next day. So, okay, so we're here on Thursday right now. And if you wanted to click on it, you could go to the report. If you click on it, you could take a look at the historical data and it'll bring it up for you. So you could see, the historical data. Here's a table. If you wanted to read about it, what is this indicator all about? And these are the scheduled upcoming events. All right, so
Perfect.
so that's in there. So let's see, if you don't have questions, maybe I'll just go to the SPY for now. It's my default symbol to go to.
Well, it does touch most of the market, right?
Right, most active ETF consistently. That's one of the most or on the top 5 most active securities traded. Let's take a look at the options chain, and I'm going to just kind of go. We'll just pick a month out here. So I guess what we could talk about is, maybe how to evaluate an option. And when we look at an option, and I'm saying this, actually, I had a very good email exchange. Somebody's asking me about the Markov chains, which I've never, used to price options. I really don't, besides just reading about and knowing a little bit how the theory behind it. I've never used it, but it's very interesting. So I am looking into it, and if anybody has used Markov chains to do any kind of analysis and has some insights or feedback, it would be great. Come on the show and show us some examples. But I like the questions because when we look at financial instruments, one of the first things as an analyst, what you want to do before you even trade it is, how can I price it? Can I come up with a model that comes up that gives me a good benchmark, a practical benchmark to figure out what the price of this should be? Okay, so it doesn't start, can I predict where it's going? Can I model what I think the price of this should be? And there are different methods of doing it. We talked about the option pricing model, which is obviously that's a very good model. In the option pricing model, let's just take this one. For example, if we open up this option in SPY, 450 call, it's 87 cents right now. So here it is. This is the option leg, buying the 450 call for 87 cents. And we could calculate what that payout diagram looks like at expiration. But what if we wanted to figure out, is 87 cents a good price? Is it a fair value? Is it overpriced or underpriced? Well, to do that, we'd need to run the inputs through some kind of model to help us out with that, ask questions. So at this point here, we did create these user entered fields that would go into the Black-Scholes model. And if you change it, those assumptions, it'll go through the model and create a theoretical value for you so you could compare, right? So in a Black-Scholes or binomial model, one of the main inputs is your implied volatility assumption going forward, right? And we know right now there are 5 trading days left, 7 calendar days, 5 trading days. So calendar days would include like weekends and days that there are no trading. But in the next, let's say 5 days, what do you think the volatility will be for SPY, right? And based on that assumption, what do you think the option price should be? Okay, so if we look at what the implied volatility is, we could work backwards, right? We could work backwards and give it a price, and then work backwards and say, well, if the price is this, run through an algorithm to figure out what the implied vol is, right? So what it will do is you enter, you would have to start entering implied volatilities to get to this price, right? But if we enter an implied volatility, we made an assumption. What do we think the price of this option should be? So here, let's just say we want to figure out, our question is, if implied volatility turns out to be, or if volatility turns out to be 11 vol next 5 days, right? What, in theory, should this option be priced at? Okay, so let's say we look at, our historical volatility. So we see yesterday SPY moved at a 13 vol, right? That's a 20-day vol, right? So yesterday's 20-day historical vol moved at 13. So in the last 20 days, if we took the 52-week average, it was 17.6. You can see the high and the low. And you could see if we did it over 252-day, it's 17.5. So let's just say, okay, the low is 8.9, last 20 days, 13. So if I just priced it somewhere in the middle there, right, it could be, let's say 11, right? What would the price of this option be in theory? Right, what were we looking at? So we could plug 11 in here. We could just type it in or use these. Here, I'm going to raise it to 11. Let's recalculate it. So here it says, if volatility will trade at 11 in the next 5 days on average, then the price of this option is $1.11, according to the Black-Scholes model, right? And then you could compare, and of course, there's no way of knowing for sure, right? If we knew for sure what the volatility will be and the path that the stock will take, and still will be, trillionaires. But we don't know for sure, so we're trying to make educated guesses and then comparing our educated guesses to the market to see, is the market, and how strongly do we feel about it, right? If volatility goes up or down. But based on that, we could start making comparisons, right? Well, how far away are the markets pricing these options from a theoretical value? So that would be a starting point of trying to see the market prices versus value. So let's go maybe towards a different way, and let's say, more of a at the money, right? So where do we stop? 447. If we wanted to see this call, where you'll calculate it, it's $1.92. So what if we gave this call 11 vol? Right, that's the question. Well, what if we think if it's 11 vol, how much difference in price would this option be? So we calculate that. and then we could compare it. So in theory, right, you got what, like 21 cents in edge if the implied volatility, or if the volatility will trade at 11 vol, right? Because it's priced right now at a 10.2. Right. So what is the difference in the volatility, and what does that translate to the difference in price? Right. And then that's how one way that you could use an option pricing model to start making inferences and calculated, educated guesses. How do we, though, come up with a forecast for volatility? Well, that's another thing. We can try to start out as a starting point to say, well, what happens if the next 20 days are close to the previous 20 days, right? Start out that way. But then we could start thinking about and saying, well, what's different about the next 20 days versus the previous 20 days, right? So if we take a look at the previous 20 days of volatility, well, maybe we had certain events come up that we don't expect to come up, like, CPI, PPI, maybe those played into the overall vol, right? Maybe there was an unexpected event in there that made the market move, but we can't predict unexpected events. But if they're random and happen seldomly, right, maybe we price that out as well. But on the other hand, if we look at our economic calendar, if we look at maybe certain things that we know are upcoming, like earnings, maybe major conferences, certain things that may make the market move, then we could start compensating for that. So just the volatility alone, it's very difficult to forecast, but there are certain methods that you could start using to say, all right, what happened? This is what happened last 20 days. Do I think the next 20 days are going to look similar? So maybe I use this as my benchmark, or should I bring it up a little bit, take it down a little bit, or is there a seasonality effect, right? So we could also look at implied volatility, and we could see, kind of like, this is historically how the volatility moves throughout the year. So it's taking the last 10 years, combining them over here and showing us historically how volatility moves. So we're like right here right now, right? We're like over here around September 14th. Actually, it's my wife's birthday. So that's why we're September 14th. We're right here. So if we looked at just the historical pattern of trading in implied volatility, this suggests that the implied volatility will start to increase, right? We're kind of on the lower range, in this period. So that's one thing we could use. We talked about the economic calendar. Well, we can take a look at the economic calendar, what's coming up, and are there things in the next 2 weeks that are coming up, that we think can be a catalyst for more volatility than we've seen in the previous 2 weeks. All right, so this is one. Here's an interest rate decision, so that could be a big one, right? We're not expected to change rates right now. The expectations are no change. But what if we get a surprise? What if the Fed does increase interest rates by quarter? Do we think that will create more volatility? We don't know for sure. The expectations are right now no change in September, maybe another hike in November. Plus, we don't know what else they will say, what kind of insights we'll get, but we know that's coming up. All right. Again, when you start to try to forecast volatility, there are lots of, different inputs, and there's no perfect thing. It's like trying to, forecast the next earnings in a stock. You don't know for sure, what the next earnings are, but you probably can get somewhat of an educated guess based on historical earnings, based on, their guidance, and maybe what's happening in between. Right. So coming back to, let me see. I got to go back to this because I think I came off it. So when we come back to I forget where I was, somewhere here. When we come back looking at, the prices as a financial analyst, for, one of the first things we try to figure out is, can we come up with a price for these securities? Okay, that's kind of like your first thought process. Well, can I come up with a price? Is this a fair value? Do I have some kind of cushion? Do I have some kind of edge in trading this security? So let's come back here. We use the option pricing model. Hold on. I did, you know what? Let me show you guys another thing here. We added this interest calculator. Forgot. So this is from yesterday. So the reason we added this interest calculator is the following: that right now interest rates are actually, pretty high. Somebody mentioned it, 5.5%. We're at 5.5% interest. Once we get there, and interest rates are that significant, the cost of carry in options is an important analysis, right? And one of the things that you want to start looking at is, are puts an early exercise? So we talked about dividends. If they're an early exercise, I did a video how to kind of make that evaluation. But let's just say you have a deep in the money put. You own this deep in the money put. Let's say on the, let's just make it easy, 470 line. So you have this 470 put. And basically, if the stock goes down, the put makes money. It's a one delta, right? So if the stock goes down $1, the put increases by $1. Stock goes up $1, the put decreases by $1. So really behaves the same as being short the stock, right? That's the put is already behaving 1-for-1 with the stock. But what happens when you're short stock? Well, when you're short stock, right, you sold stock and money comes into your account. So if money comes into your account, you should be using that money for at least some risk-free interest bearing. Either you're earning, is your broker is sweeping it and you're earning interest on it on a daily basis, or you buy treasury, short-term treasury or something, but you should be earning an interest, at least the risk-free rate, right? That's the assumption, that you're going to earn at least the risk-free rate. Well, then you got to decide, well, then should I exercise this put? Well, if you exercise the put, then you get money in, right? So you're no longer holding something for $25. You're basically exercising and sell this you at 470, right? You exercise the strike. So you're selling it short. So we could calculate, well, how many calendar days are left? So if we have 7 calendar days left, and you exercise it 7 calendar days for at 470 strike, well, that will be equivalent to 50 cents in interest. right? So 50 cents per contract, right? So you're making 50 cents in interest over the 7 days. We could look at it per day, right? So per day, if we did it one, right, 7 cents, and then 7 days, 50 cents. So that's 50 cents per contract, right? And that's a lot. That's a lot. Why would you want to give up that interest, right? It's not efficient. So how do we determine, though, if it's we could do another check. Well, what happens when we exercise the put? Well, if we exercise the put, right, we're short stock, but now we're no longer protected at the 470 strike, because if the stock goes to infinity, well, we gave that up because we exercised the put, right? So how do we protect ourselves on a 470 strike? Well, we could buy the call, but the call is only a penny, right? So what happens? We're short stock, but we could buy that call. So if the stock does go to infinity, okay, we lose on the stock for sure, but our call will go into money, and at 470, that will go up 1-for-1. So what we're doing is basically saying, okay, we exercise the put, buy the stock, we still have the synthetic put, but this way it'll cost us a penny and we'll make back 50 cents over the life of that, to maturity, up to September 20. Okay, so cost of carry, this is extremely important thing you have to monitor when you're trading any asset, options or not options. So the cost of carry, your carry cost of your positions is really important. So I created this, just as a quick reference. Maybe I'll enhance this, but I did want to put it in there just to kind of show a first example of, starting to look at your cost of carry and calculate.
Well, that was awesome, D. We're 2 minutes into the opening. We know we started a little late today. I apologize about that. Great job, my friend.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and I hope to see you guys tomorrow.